In September 2008, the internal risk desks of the world's largest banks realized the same terrifying math at the exact same time. The collateral backing the global financial system was evaporating. Credit markets began to freeze completely. The crisis forced the U.S. government into a brutal triage. When Lehman Brothers, a massive Wall Street institution, pleaded for a lifeline, regulators allowed the firm to collapse. A few blocks away, Goldman Sachs faced its own devastating exposure through the failing insurance giant AIG. Instead of facing bankruptcy, Goldman received a direct flow of cash. The government rescued AIG and quietly funneled full-value payouts straight through to its trading partners, handing Goldman roughly $13 billion. The man who approved that rescue, Treasury Secretary Hank Paulson, was previously the chief executive officer of Goldman Sachs. The firm that engineered destructive financial weapons emerged from the blast protected by the very government it nearly bankrupted. To understand how that survival became a repeatable business model, you have to look at what they were actually selling. In 1869, Marcus Goldman started by walking the streets of Lower Manhattan, brokering simple commercial paper. He would buy IOU notes from small merchants at a discount and collect the full cash later. It was relationship-driven debt brokering that required knocking on doors the banks considered beneath them. By 1906, the firm was taking Sears public. At the time, a company's value was strictly measured by physical assets, buildings, steel, and massive machines. Goldman argued that Sears was worth more than its property. It was worth its brand, its reputation, and its future promise. They convinced investors to price the company based on intangible assets the public had no independent way to verify. This technique became the foundation of pricing the future. If value lives in an intangible forecast, price is whatever an expert says. Once built on selling the unverifiable, the only safeguard is the character of those running the institution. Goldman Sachs has spent over a century weaponizing this information asymmetry, positioning itself as the primary authority in markets where the buyer cannot independently check the math. In 1928, the firm launched the Goldman Sachs Trading Corporation, an investment trust seeded with $1 million of their own money. They sold shares to the public for 10 times that amount, then used the trust's cash to buy back their own stock, artificially pumping the price. They layered new trusts on top of the old ones, creating a pyramid that relied entirely on new investors pouring money into the bottom. When the market cracked in 1929, the pyramid collapsed. While the partners survived the loss, the public lost closer to $475 billion in today's money. Decades later, the firm employed the same structural logic during the housing boom, culminating in a product called the Abacus Collateralized Debt Obligation. Goldman bundled toxic mortgages and sold them as stable investments. They hid that a hedge fund manager helped select the loans while actively betting against them. Investors lost $1 billion, while Goldman collected fees from both sides. Engineer a complex product, extract the fees up front, secretly position against failure, leaving the public holding the losses. Maintaining this cycle requires significant political influence. Former Goldman executives move seamlessly into the highest levels of global power, running the U.S. Treasury, the Bank of England, and the World Bank. These alumni often shape the rules that govern their former employer. In 1999, Robert Rubin helped repeal the Glass-Steagall Act, a law designed specifically to prevent the kind of risky investment banking that nearly destroyed the firm in 1929. This structural power allows leadership to deny the very risks they create. During the 2008 crisis, Chief Executive Lloyd Blankfein publicly insisted the firm didn't need a rescue, even as internal records showed their risk desks were sounding alarms. The model scaled globally with the 1MDB scandal. Goldman raised billions for a Malaysian sovereign wealth fund, overriding internal warnings about corruption, to collect $600 million in fees. Roughly half of the money raised was immediately diverted into shell companies and used to fund Hollywood films. The revolving door ensures that when personal loyalty and institutional survival conflict, the rules are rewritten to protect the institution. In 2016, Goldman Sachs attempted to pivot away from its traditional model. They launched Marcus, a retail bank aimed at ordinary consumers rather than governments or the ultra-wealthy. The centerpiece was a partnership to launch the Apple Card. For the first time in 150 years, Goldman was not the seller with a built-in advantage. They were the buyer, competing in a market where they had zero informational advantage. A culture built on pricing the unverifiable turned out to be spectacularly unequipped to underwrite the credit risk of ordinary Americans. They underpriced the risk more badly than subprime lenders, whose entire models were built on everyday spending psychology. The result was a $7 billion cumulative loss and a humiliating retreat. Goldman eventually offloaded its card portfolios to J.P. Morgan Chase at a significant discount, ending its attempt to compete on Main Street. Goldman Sachs profited for over a century by making its risks someone else's problem. The moment they bought a risk they couldn't push onto the public, the firm failed instantly. Goldman Sachs survived by making sure nobody outside the building could verify what was inside, but their model relied on the constant rotation of risk. Today, a new entity has emerged that operates on a different scale. This firm doesn't need to offload risk because it has quietly become a primary pillar in the ownership of the global market. This is BlackRock. It is often the largest shareholder in both sides of a corporate rivalry, simultaneously holding massive stakes in Boeing and Airbus or Coca-Cola and Pepsi. When one firm holds the voting power at both ends of the table, the concept of risk changes. The question is no longer who gets paid when a product fails, but what happens the day the owner of everything decides to use its vote.